indicator. It shows I think 97% chance that the Fed's going to cut rates again. Um, I don't know. CNBC used to be a little bit more sophisticated than it is now, and you can see a lot from this new anchor that he just gives a bunch of like softball questions or kind of questions for uneducated people. I don't know which, but a lot of the other anchors and a lot of the other shows give you more hardball, insightful questions.
It's being all about the bond yields and the 10-year. We were on with you in December and saying we could get to 5%. And I think that's still our baseline that actually you could get from 5 to 5.5% at the high end. And that would just be a normal, healthy economy. I mean, it's a positive that we've got the yield curve going uninverted, that the 10 years higher than the Fed funds. You're now around 50, 55 basis points higher.
Also, there's this huge divergence between the 10-year and the discount rate, which is a little alarming. I think it's going to go above 5, especially with all the maturities that are going to that are going to mature in 2025. So there's going to be a lot of auctions. If you want to sell if you want to sell the treasuries, you need to kind of sweeten the deal. So I expect prices to go up.
But the normal is 100 to 120. So, that'd be another 50 basis points higher from here, which is why we say 5.25 is definitely very reasonable. And that does put more competition. The earnings yield on the S&P is getting less than that 10-year treasury. Now, we still think you compare it to tips, but there is more competition from bonds.
All right. So, Joe, you're saying the bond market is creating competition. It's not necessarily that the higher bond yields have a fundamental reason to make stocks sell off, but you're saying it's just the competition. People are putting their money over there. But I do want to ask, we've seen so much mania in the markets. Remember the quantum computing trade that's kind of unwound since Jensen Huang? We've seen the AI trade. Are you saying sentiment has shifted so much that people before, they thought there was basically no alternative to anything but
Everything
equities
about
just
the
because
economy.
of the possibilities? Now they just have a more reasonable mindset, or are they scared of the volatility in the equity market?
Well, I do. The stocks are always the present value of cash flow, so you get a higher discount rate, and that does bring down valuations. The quantum is in its own world. I mean, you got the Mag 7 that's like 30 times earnings. The quantum is on all sorts of future expectations, and so those are really
So every time you hear the word Mag 7, it's the top 7 equities in the S&P 500. It's definitely heavily weighted in pulling the S&P forward, or it had been pulling the S&P forward. There's been some correction in the last few weeks.
speculative stocks. But if you talk about the core S&P 500 and then the tech stocks surrounding it, you just talked about Zuckerberg's comments on Apple. Some of those are not cheap stocks, and they've got to deliver on their earnings growth. But they have been. They've been delivering twice the earnings growth as everything else, so they deserve the 30 times earnings for the Mag 7 versus call it 17 to 18 times for everything else. But as that 10-year peaks out, that's when I think you get another move higher in the markets. But it is again a healthy economy that's driving these 10-year yields higher.
All right.
So again, I believe that the 10-year, the reason why it's going so high is all the treasuries that are about to mature in 2025. They're definitely going to have to, and I think the market's starting to get ahead of it. But they're definitely going to go up, which means housing is going to have an issue. Housing prices are going to. I don't know if housing is going to increase, but those mortgage rates are definitely going to increase, right? Which means people who are buying housing it's going to become less affordable.
So it's interesting you're saying that. So you're saying once the yields peak out, you think it can get up to 5.25. Once people just feel like it's stable, then the bull market continues. Our Mike Santoli, he had a really interesting column over the weekend. I want to show the audience this. It's the average bull market and where we're at in the bull market right now. Any thoughts about some of this volatility just being normal and maybe overblown? If you look here, the blue line is the average bull market. It continues going for about 800 days. And then the current trend is the orange line for people just watching and not listening. I know some people might be in the gym. Is it about 600 days? Do you agree with this idea that we're actually just kind of seeing some churns in the bull market and that we just have more room to run and this short-term volatility is maybe overblown?
Yeah, no, I think it's all natural for what we see going on now.
So because of what's happened with the recent correction, it's not really a correction because it hasn't been 10%, but you've seen the market decrease a little bit. I would say, yeah, there's some room to grow again. It's healthy for the market.
We think this pullback has, as we said, the 10-year could go higher. So we think that's still pressure. Eventually, you'll get this rotation. We haven't seen, say, that value or small cap rotation. The small caps really relying on the Fed cutting because they're the one paying the higher borrowing rates. But the valuations are being pressured a little bit, which is normal and healthy. And then as people get confidence, those yields are going to stop rising. We think we get a continued good take in the market.
Jeremy, we're almost out of time, so we got to keep this very short. You actually gave us a pick today. You're talking your own book. It's the Wisdom Tree Quality Shareholder Yield ETF, the WTV. You believe that the value trade is going to reaccelerate. What's sparking the value trade in your mind? As we look in 2025 and going ahead, aren't value stocks also hit by these higher yields?
Well, what I love about this fund, they do a lot of dividends and buybacks. So
I would say value stocks are hit less by the high yields.
the buyback yield combined with the dividend is around 7%. You have a 13 PE, so 10 points lower than the S&P. So when you think about those yields pressuring valuations, these are 10 points less, and they're doing a lot of buybacks. So the companies, the management, they're voting with their feet. They're buying back their own stock in big numbers. 5% shareholder yield is a big number. And so we think that's a good way to protect from some of the high valuation of the market.